This brief video will explain how the rate of return on investment works. Rate of return on investment is one of the most common ratios that are used to determine the value of an investment. If you think of it in terms of a personal investment, when you put money in a certificate of deposit or in a savings account or for your retirement, the rate of return on investment is the percentage that you're going to get back in interest or in income from your investment. And it's the same thing for a business. A business invests in assets with the expectation that they're going to receive income back from that. So when we talk about an investment, if you recall way back when we did the cash flow statement, the section on cash flows from investment activities included when you purchase plant, property, and equipment, when you invest in your own company. So if we think of investment as what we put in our own company, or if it's in something else that we invest in, that would be your investment. So your rate of return on investment is your operating income divided by your invested assets, and it's going to give you a percentage, and that would be your ROI, or your rate of return on investment. We also can break this down in a business into two separate things, and the book calls this the DuPont formula. And the first part of the DuPont formula is the profit margin. And profit margin is operating income divided by sales, which basically tells you what percent of your sales are you able to bring down and have as income. And then the other part is called investment turnover. And investment turnover is sales divided by invested assets. Anytime you have a ratio that is called a turnover, you're not talking about a percentage, you're talking about how many times. So how many times, did our invested assets create sales? So it wouldn't be a percentage, it'd be something like 2 or 2.5 or something like that. If you multiply the profit margin times the investment turnover, just understanding how the basic things of math work, you can cross out the sales and you're going to get operating income divided by investment assets, which is ROI.